Hello, everyone. Welcome to this session brought to you by Kenanga Futures that is titled The Impact of Rising Inflation and Interest Rate on Commodities Market Outlook for second half of 2022. All right, so hello, everyone. My name is Shane Choo. I'm the moderator for this session. So in this session, we are going to examine deeply into the impact of rising inflation and interest rate on commodities. And then you're going to learn to understand the relationship between inflation, interest rates, and commodity prices. We are going to talk about the commodity market outlook for the second half of 2022. And we're going to disclose, several inflation strategies using commodity and interest rate futures, which is a huge topic. All right, today we have invited a very heavyweight speaker, from GFM Group Limited. I will introduce his profile in a short while. So while we are getting all of you here into the room right now, let me just do a quick shout out for Kenanga Futures campaign, which will be launched on the 8th of August, 8/8 date. All right. So for those of you who want to join this campaign, you may sign up an account with Kenanga Futures at the link that I've just given you on Facebook. Of course, we also give the link on YouTube and in the GoToWebinar software in a short while. So we'll give you the link to sign up an account with Kenanga Futures. And for those of you who want to trade CME Group products, you will stand a chance to earn up to 28% cashback in this campaign, which will be launched on the 8th of August. So stay tuned for more information where we will let you know on the 8th of August. All right. So before we begin, just want to do a disclaimer. Whatever we share in this session is only for educational purpose. So in no way that we give any recommendation for you to buy or sell any listed securities or futures that we mentioned here. Yeah. All right. So if you decide to make any trading decisions, you're 100% responsible for all your trading risks. Okay, so allow me to briefly introduce our speaker today. He is an independent wealth advisor with GFM Asset Management LLC and also GFM Group Limited. He has been in the market since 1998 with stints with Commerce Bank in New York, London, and Frankfurt. He was also with Bear Stearns in New York, in JP Morgan with New York, in Canadian Imperial Bank of Commerce, and also Societe Generale in Hong Kong. He has a master's in financial engineering degree from University of California at Berkeley. Aside from that, he's also a lecturer at ESSEC Singapore with a focus on topics in fixed income and also alternative asset. He is also a renowned author of this book, Invest Outside the Box, okay, which is very interesting title. All right, so he's none other than Mr. Tariq Dennison. All right, Tariq, it's good to have you here in the room today.
Thank you very much for the kind introduction, Shane.
All right. So I shall stop sharing my screen and hand over the session to you.
Thank you. Waiting for the share button. All right, here we go.
All right, cool.
All right. All right, I believe you should be able to see my full screen now. I notice there's a little bit of a lag. Well, welcome everybody, yes. And thank you for joining my market outlook for the second half of 2022. As Shane mentioned, we're going to be talking about inflation, commodities, interest rates, and most importantly, which futures contracts you can follow and trade to actually track any of the things that we're going to be talking about today. And as Shane mentioned earlier, please read this very important disclaimer. And as you can see, Shane's introduction on me was basically a version of my usual intro slide for any of you who have never attended one of my presentations before, you'll notice the one little line there that he took out because we weren't exactly sure how to discuss it was the line where I say neither standard nor poor. And the background on that particular line is that I've been a long-time critic of the S&P 500 index, the Standard & Poor's 500, which I argue is both a standard index and a poor index. And if I were to summarize my way of viewing the market in a pair of lines, it's that I really try to have neither a standard view nor a poor view. I very much focus on the richer, unappreciated portions of the market, which are neither standard nor poor. That said, my brand is very much the GFM brand, and you can see my first book here. I'm working on my second book, which I highly encourage you to follow me on Seeking Alpha, Twitter, and other sources to see where I'm working on next. Now, what are we going to be talking about today? As we mentioned, it's going to be about inflation with an exclamation point and recession with a question mark. These are the main economic variables which have been getting a lot of attention for the first half of this year. Really, inflation for the first half. Recession, I would say, is the big question mark for the second half. I'm going to put those two pieces together and say, really, how do those feed in to what interest rates are, what that's going to do to interest rates, and most importantly, why your interest rate trading strategy should be a central first step to anything that you do after that. So interest rates, as you've been following them, have been rising really as a result of those two things that we've mentioned. One is the expectation of higher inflation and the Federal Reserve raising rates to combat that higher inflation. Now, when you talk about rising interest rates, not all interest rates rise at the same time. I'm going to be talking about the difference between the 2-year, the 5-year, the 10-year, and the 30-year, and how rising short-term interest rates don't necessarily mean rising long-term interest rates. The other big news story of this year, which is related to the inflation story, is of course Russia's invasion of Ukraine. That has resulted in inflation. That's resulted in something actually quite similar to the 1970s, where we've had a shortage of oil supplies, which resulted in higher oil prices. Higher oil prices are just one reason that inflation has been higher this year than before. Monetary policy is, of course, another driver of that. I have my own views on why I don't believe that inflation is sustainable, and we're going to be talking about that in later slides as well. But I can't talk about inflation without talking about gold. So when we talk about other commodities, the first commodity I always talk about is oil, because oil is really what greases the wheels of the world economy, still today and will be until the middle of the next decade. But when people talk about gold, they ask me about gold. Is gold a hedge against inflation? I want to make sure that everybody here on this presentation is very, very clear on why I see gold as a very, very lousy hedge against inflation. So one of the questions to ask is, why is it then with inflation hitting 40-year highs, gold is actually down this year? Some of you who follow gold know that. Some of you who don't follow gold may not have known that, may wonder why. We're going to be talking about gold, and if you want to trade position on gold, how you can trade that with micro gold futures. Last, to wrap out the 3 commodities we're going to be talking about here, there are of course dozens of commodities we could be talking about, but I just wanted to introduce one commodity that is neither oil nor gold, and it was one that's appeared a lot in the news this year as well, and that commodity is wheat. Wheat, of course, is used to make bread. It is a central ingredient in lots of food, lots of staple foods that involve bread, pizza crusts, pastas, cakes, anything else you might feel. Ukraine was a major exporter of wheat. And so obviously Russia's invasion of Ukraine impacted wheat prices. Rising wheat prices have impacted inflation in many, many different economies around the world. I'm just going to be giving you a crash course on wheat so that you can understand how to trade wheat futures if that is your other commodity of choice in the agro space. That's going to be enough to keep us quite busy. I would obviously love to talk about many other things, but 2 key asset classes, 2 key futures contracts I will not be covering in this presentation are going to be equities. So I'm not going to be talking about S&P 500 E-mini futures contracts, the NASDAQ, or any other equities, unfortunately. And I'm also not going to be talking about crypto, Bitcoin or Ether futures. If you have interest in those, obviously, please tell Kenanga, please tell CME, please write to me directly. I'd love to talk about those topics on another presentation. So on the left are the fundamentals of why we should be interested in those things. On the right is the action side. So if we're interested in trading interest rates, I'm going to introduce you to the micro yield futures contracts, which you can trade to directly profit from rises and falls in interest rates. Then going to be talking about the micro oil futures contracts, which you can use to gain exposure to rising or falling oil prices. Then there is also a micro contract on gold. So that is going to let you trade long or short positions on gold in 1/10 of the size of the old big futures contracts. I'll also be telling you a little bit about what's the difference between trading gold via futures versus via an ETF. And then last, in terms of futures contracts, I'm going to be talking about wheat futures. Wheat, as far as I know, also has a mini micro contract, which is relatively new. So depending on how much exposure you want to the wheat market, wheat prices, whatever your strategy is there, you can incorporate that into your future strategies as well. As mentioned, I'm not going to be covering the micro E-mini S&P 500 or the Bitcoin or Ether futures in this presentation, but those are there if you would like to learn more. So first title topic, inflation hits 40-year highs. You've probably seen many headlines and many presentations about this. What exactly does that mean? Inflation, in a nutshell, is just a measure of how much the price of goods and services that your average urban consumer buys, your average resident of a city, has to pay for the same exact stuff that would have cost $100 last year. So what 9% year-on-year inflation means is that if we took a basket of goods, a basket of things that your average consumer would have spent $1,000 on last year, so that would have included soap, rent, fuel for your car, your food, all of those things. Let's say last year, June 2021, it would have cost $1,000. That basket of goods now in June 2022 is going to cost $1,090, so 9% more. $90, is that a big deal? 9% inflation is 1 year is really high for an advanced developed market like the US, Germany, or Japan. These are numbers that we have not seen, my guess is, in most of your lifetimes. You really have to go back to the late 1970s, early 1980s to see that level of inflation before. And you saw even back then, those levels of inflation didn't peak much higher than that. They didn't last very long. You can obviously tell what's the difference between 1982 and 2022 as far as how the economy is different structurally and so on. But this is a reason people are concerned about inflation. If you had money in a savings account over the past year earning just 1% interest, you effectively lost 8% in purchasing power by keeping your money in safe cash. So that's the reason that many savers hate inflation, is because it basically is a tax on any savings. It's a tax on any cash that you might be having lying around. So generally not good. That's inflation. What do we do about it? Or how do we better understand inflation? If we look into the report of any agency that reports inflation. Earlier I mentioned a basket of goods. So I mentioned, what does a consumer spend? $1,000. We'll be buying a pizza that he orders out. We'll be buying some bread and some cheese to make meals at home. We'll be buying fuel to heat your home and gasoline for your car, all of those types of things. This is what the changes are on those individual items in that basket of goods. And you'll notice here there's a major breakdown between food and energy, which tend to be the most volatile parts of the basket. And here you'll notice energy was really the biggest component, the biggest rise in prices on this, with the only other major outlier being used cars. If you've heard in the US right now how expensive it is to buy a used car, that's also relatively unusual. Food is then the second most significant item, which is why we're going to be talking about wheat. But actually many other things, the costs of rent and a laptop, for example, those have actually not been rising in price quite so dramatically. So that's why we're going to be talking about oil futures and wheat futures. We're not going to be talking about, say, SD-RAM futures, which are something which obviously have a very different market dynamic to them. So as I mentioned earlier, you can be looking at food, energy. That is one volatile component of the inflation basket, different than the rest of the inflation basket. Now, in terms of the weight, the food and energy prices are also something we pay attention to, because even though those are the most volatile, even though that's where we see plus or minus 40% swings in prices, we have 9% inflation, not 40% inflation, because food and energy combined are only 20% of the overall basket. If you think about your typical household budget, and obviously not just a typical Malaysian household budget, but an American household budget or German household budget, how much of that monthly budget would a family be spending on food and on energy? at least according to the US Bureau of Labor Statistics, that's around 20%. Americans, by and large, do spend a lot more on cars, but they actually don't spend that much on fuel because taxes on gasoline are very, very low in the United States. If you look at what you pay for a liter of petrol in Malaysia, it's usually traditionally been about double what an American would pay for a similar amount of fuel. That's actually come up because the price of oil has been much, much higher relative to the tax on fuel. So that's why you may be looking at how much you pay for fuel in Malaysia and say, well, it's risen, but not as much as it has for an American, whereas an American paying $6 for a gallon of fuel is absolutely screaming in pain right now. That's some of what the consumer experience of inflation is that you might be hearing about if you listen to American media. Now, one important quote from the famous economist Milton Friedman in terms of what causes inflation. And I like remembering this because it's something that's easy to forget if you focus on just the prices of goods and you say, well, what does this have to do with Russia's invasion of Ukraine, or what does this have to do with supply chain shortages? You cannot have inflation unless you have more money. So remember Economics 101, supply and demand. If you have the same amount of goods and more money to buy those goods, that's going to cause inflation because there's more money chasing the same amount of goods. On the other hand, if you have twice as many goods and twice as much money, that's not going to produce inflation because that same money is chasing effectively the same amount of goods dollar per dollar, more goods than more supply. That is my main explanation for why we did not see major inflation after the 2008, 2009, 2010 financial crisis. At that time, we had major financial stimulus, and everyone was talking about in 2008, 2009, well, this is going to produce lots and lots of inflation, and we never saw that inflation. The reason is because China's production, China's export capacity, more than kept up with that increase in the money supply. What we've seen over this past year, on the other hand, is we have not seen an increase in productivity that has kept up with the increase in the money supply. So you never see inflation without an increase in the supply of money relative to the supply of goods and services that people want to buy with that money. That's why, for example, you don't see an increase in inflation in Japan. The Bank of Japan has been pumping money into the system, but not enough money in order to chase an actual increase in goods and services that Japanese have been buying. So very, very important to keep in mind whenever you want to look at inflation and see if inflation is sustainable. And this is going to feed what I'm going to talk about later when I say I don't think that 9% inflation is going to last. I believe the numbers that say 2.5% to 3% inflation is what we should expect over the next decade. Now, where am I getting that number from? Am I just more or less pulling it out of the air? Well, really, if you look at that inflation number that I showed the chart of earlier, which showed that spike at 9%, really what it is, in my view, is it's a catch-up to what the supply of money should have been if long-term trends from the 1960s to the 1980s had been maintained. Now, this chart may be of a variable that you may not follow very often. It's what's called the M1 money supply. This is the narrowest measure of the supply of US dollars. So this is US dollars that's basically in demand deposits and checking accounts and can be drawn immediately. It does not include, say, term deposits. And basically you expect this to rise over time as the Federal Reserve or central banks increase their balance sheets, as more money gets printed, as the economy grows. But you'll notice something very, very interesting happened in the 1980s. In the 1980s, the US economy continued to grow, but the rate of growth in the money supply actually slowed down. And throughout the 90s and 2000s, the money supply more or less tapered off. It increased at a higher rate than before in the 2010s after the impact of the global financial crisis. But if you look at that major spike, that significant spike during COVID, where the M1 money supply basically went from $4 trillion to $16 trillion, really what you think is a fairly significant jump in the US money supply, that's actually where it would have been if the trend in the M1 money supply from 1960 to 1970 had just continued for those following 50 years. So that's where I really try to take a step back and take a real long-term perspective from a supply point of view. Is the amount of money, is the US money supply that we've suddenly seen spike really out of what we'd expect a long-term trend to be? Or is it really just undoing what Volcker did in the early 1980s, and we're now resuming back to what normal should have been from a 1960s to 1970s point of view? This is what I would say is a non-standard view on inflation and the money supply, but it's one that I use, and in my view supports a non-sustainable 9% inflation view. Obviously, if you disagree with me, your trades on the futures contracts I'm going to mention are going to be different, but I'm going to leave this with you to make up your own mind. Now, so far, I've been talking about the inflation side of the picture. That's just the price of the goods that you buy. What you would have spent $1,000 on last year, you're going to now spend $1,090 on. It doesn't account for the fact of, are you actually making more money this year? Are you actually wealthier this year? Are you able to enjoy a higher standard of living this year than you were able to last year? That's the real growth that most of us care about. We care about, will our children live a higher standard of living than we do? And are we living a higher standard of living than our parents did? That only happens when this line, which is percent change in real gross domestic product, real economic output, that means not counting inflation, is positive over and over again for long, long, long periods of time. Now, whenever you see a gray line going up and down, a gray bar, you'll notice that's because that blue line has fallen below zero. Whenever economic output is negative for 2 quarters in a row, that is the technical definition of a recession. And you'll notice that those gray bars, those negative points below, tend to happen about every 7 years or so, but usually we want to see US economic growth, we want to see growth actually of any of our economies, a positive 2% plus, sustained for a fairly long period of time. That's what's going to allow, let's say, our standard of living to roughly double in quality about every 30 years. If it doesn't, if it stays around zero or negative, you're going to have a few decades like what Japan has faced over the past 20, 30 years, where Japan's economy is about the same size now as it was in 1990. That's not something that I think many of us want for our children over the next decade, but that's why politicians don't like recessions, voters don't like recessions, and that's why you saw the White House recently come out with a statement saying that even though the economic number is about to come out, we do not think we should anymore define a recession as 2 quarters of negative economic output. Remember, it is an election year in the United States, and this is something that I think is quite sensitive. When your prices are going up, but your actual ability to buy more stuff is not going up, your things are getting more expensive and you're actually having to buy less, you are going to feel poorer next year than you did last year. That is something called stagflation, rising prices but stagnant economic growth. That's a worst case scenario for many people from an economic point of view. Now, why am I talking about these two numbers? I talked about inflation and I talked about real growth. These two numbers ultimately feed what that interest rate is, and that is why those interest rates I'm going to talk about are so important. Even if you're not planning on trading interest rate futures, you need to look at what these numbers are because they will tell you whether the economy is growing, whether to expect high rates of return from your stocks, whether to expect the prices of wheat to go up. Because what does an interest rate tell you? An interest rate tells you the market rate of interest, the market compensation that someone is going to demand to lock away their money at a fixed rate of interest for 2 years, 5 years, 10 years, or even 30 years. You know, if I told you, for example, you're going to take $10,000, you're going to lock it away for 2 years, and you're going to demand some interest in exchange for locking away for 2 years, what interest rate would you be willing to accept? And I'm not just asking you, I'm asking millions of savers that have $10,000 that they're going to be competing to get a rate for on that money. Well, at the very least, most people want to at least be compensated for inflation. You know, so if I'm going to put that money away for a year and I'm going to expect 2% inflation over the next year, I at least want 2% interest so that a year from now when I get my $10,000 back, I'm not going to have less purchasing power than I did a year before. That's a base minimum. But most people are also going to say, I don't want to just get paid for inflation. I also want to get paid an additional real return for actually locking away my money and not earning growth opportunities and other investments that I could have made. And usually that's proportional to the rate of real economic growth. That is why I often say if you add these two together, the neutral level or the expected level of what an interest rate should be should roughly be the sum of these two things. And the definition of that is what you call nominal economic growth. So not economic growth after adjusting for inflation, but economic growth including the rate of inflation. In other words, if I expect the economy to grow 4% in nominal terms, I should expect a 4% interest rate on my savings if I'm going to lock it away and not get that growth. Now, as people get older, as more and more people with $10,000 want to earn that safe rate of interest, they're going to bid that rate of interest down, which is why the real rate of interest earned on savings over the past several years has actually been negative. And the big rise in interest rates this year has actually not been a rise in inflation expectations, but rather a rise in the demand for savers to get paid more than zero above the rate of inflation for locking away their savings, if that makes sense. So that goes back to the other question, which may have seemed a little bit strange given what I've said. I've just said that inflation is over 8% or 9% actually in the recent print. How is it that interest rates are only 3%? Well, remember that the interest rate terms that I'm talking about 2-year, 5-year, 10-year, 30-year terms. And that inflation rate that I gave you is 1 year, year on year, and that's looking over the past year. That's not the next year expectations. So if somebody is willing to take only a 3% interest rate for each of the next 2 years, that means a few things. One is that they're expecting that there's going to be a good chance of a recession, that inflation rate is not necessarily going to be sustained. The Fed is going to respond by cutting interest rates. So really all of those feed into the expectation that that 8% rate, most of the market is expecting that's going to be a blip, and that we're probably going to go back to a 2.5%, 3%, and that 3% interest rate is really just compensating you for that. The worst case scenario, which you could say many bond buyers are not expecting, is a stagflation scenario where you see 5% inflation with no economic growth for the next few years. That's going to be bad for stock investors and bond investors. But in general, if there is a recession, interest rates tend to go down and people buy bonds as recession insurance, if that makes sense. So if you read the bond market, so in other words, if you, instead of saying, well, this is what inflation just was over the past year, what is the bond market telling you that nominal US growth is going to be over the next 10, 30 years? Well, the 10-year yield is around 3%, the 30-year yield is around 3%. If you believe those bond yields, then you're looking at long-term US nominal GDP growth around 3%, of which around 2% is probably going to be inflation, 1% is probably going to be real economic growth. If not, if you think it's going to be higher, well, you're probably going to want to buy these micro yield futures, and if not, you're probably going to want to sell these micro yield futures. That in a nutshell is what's there. Now, why is it that I don't think we're going to see sustained higher interest rates? What do I think is going to really put a headwind on interest rates rising further? In a word, demographics. What is the biggest difference I keep pointing to between 1982 and 2022? In all of the countries on this chart, populations are older now. In other words, in the United States especially, but also in Malaysia, also in Indonesia, also in Mexico, the average population, the median population, has just simply gotten older. Old people are living longer, they've had fewer kids, and so the balance between young people and old people has changed. Why does that matter in terms of interest rates? Well, in general, old people tend to have savings and they tend to buy bonds with those savings. They don't tend to borrow money and take out mortgages, and they don't necessarily need to borrow a lot in order to buy factories to hire lots of young workers, because there aren't as many young workers. And without as many young workers, you don't have as many young people taking out mortgages, borrowing money. What does that mean in terms of the balance? You have a lot of people with savings that they want to lend money out and earn a safe rate of return on those savings. You don't have a lot of people who are willing to borrow and push up those interest rates. That's just purely from an interest rate market perspective, but that also has implications for economic growth. The older an economy is, the slower the rate of economic growth is going to be, and the harder it is going to be to stimulate inflation. I mention the Japanese economy a lot because I think Japan is a warning for what many other economies are going to look like in about 10 years. Japan has the oldest population from a median age point of view, with Germany and Italy just a little bit behind it. And it's really, really hard to grow your economy at more than 1 or 2% a year when your median age is 48. It's something I'd love to hear if you have ideas otherwise, but that's a reality of life that I think is going to be a very important long-term trend to watch. Now, what does that translate into actual yield? So I've mentioned several times before, 2-year, 5-year, 10-year, 30-year, they're all around 3% right now. But it's important to look at these from a long-term perspective, from a point of view of the overall yield curve. This chart is from the St. Louis Fed, and it shows what those 4 key interest rates have been going back to about 1960. Now, why am I going all the way back to 1960? Well, at that time I was also charting what the money supply was. I also just want to show you what the difference in long-term versus short-term interest rates has been since then. Now, before about 1980, even about 1985, there really wasn't much of a term structure of interest rates, if you will. The curve was generally quite flat, generally tended to move up and down together. Paul Volcker, as you know, was actually quite famous for raising interest rates in order to fight inflation. And as you can see in that recession in the early 1980s, that really did choke off the economy. The Fed then was able to cut, and you never saw double-digit interest rates in the United States again. Now, in the 1990s, in the early 1990s, that was one of the first times you really saw short-term interest rates being cut, but then long-term interest rates kind of stayed there. They didn't fall as much as short-term interest rates did. The bond market was basically saying, we don't think this is going to last. The Fed is cutting in order to stimulate the economy short-term, but long-term bondholders were still demanding, 6-7% interest because they knew the Fed was going to have to hike again the moment they saw inflation. That's exactly what happened in 1994, and you saw for the rest of the 1990s, the curve was more or less flat again. The 2 eras of really, really steep yield curves and really coincided with low yields, as we saw in the 2000s and again in the 2010s. I could spend a lot more time going into every single one of these Fed cutting and hiking cycles and where that made the curve steep and the curve flat. But the title of this slide is the most volatile Fed in the post-Volcker era. Really what I'm pointing out here is that cycle between 2020 and 2022 is the shortest cycle that we've seen really since 1980 in terms of the, cutting and hiking, and interest rates pretty much going from 0 to 3% in a short period of time. That's where anyone who tells me that bonds are boring, I think has not been paying attention to the 2-year yield this year. This has been one of the most exciting years in many of your lifetimes for trading the 2-year. Now, if we zoom in more specifically in the past 10 years, this is what the 2-year, 5-year, 10-year, and 30-year look like. And I mention these because these are the 4 points you can trade with these micro yield futures. Now, for much of the early part of the decade, much of the early part of the 2010s, we saw your typical steep curve. Short-term interest rates were almost 0, long-term interest rates were bouncing between 2.5 and 4, and they went up and down for a period of time. And then from 2016 up to about 2019, you saw the Federal Reserve was hiking with the expectation that they needed to, quote, normalize interest rates. Now, by 2019, you saw that that was already starting to take a pause. They were already starting to realize what I was saying at the time, which is 3% is the new 5%. I do not see the US economy being able to handle interest rates over 3% for any sustained period of time. I believe that has to do with the shape of the US demographic pyramid, how many old Americans there are versus young Americans, the nature of the US economy, the fact that there isn't much demand for borrowing for capital intensive projects, the fact that China has been repeatedly buying lots and lots of US treasuries. There are lots and lots of reasons why I believe it's going to be hard for US interest rates to go much above 3%, and that's the limit that it's testing right now. So the big question for you is, great, all of these micro yields are at 3% right now. What are you going to do next? What are you going to expect to see next? And that's exactly what I hope you can figure out and you can make a decision on once I show you what these futures are and how to trade them. So I've mentioned these micro yield futures a few times now. What are they? Where do you trade them? How you trade them? Well, these are all CME listed futures, and you can trade them in your Kenanga Futures brokerage account. But as implied by the name, they are micro size, meaning that they are smaller than the old 10-year and 30-year that you might have heard before. But they are also futures contracts on yield. So if you see the 2-year yield is 3%, you are actually trading that 3% number directly as it goes from 3 to 3.1 or 2.7. These are not bond futures. That is why I put in big red letters here. If you are familiar with 2-year Treasury note futures, these are not those. They are not similar to them in any way. So if you've traded those 2-year note futures, 10-year note futures before, put whatever you know about those aside and listen to what I'm going to say here about how these futures work, because these are very different and in many ways very much simpler. So To give you an example of how these are quoted, as I mentioned earlier, if we want to look at the 2-year and the 10-year, these are the two most liquid tenors, the most commonly followed and traded tenors. What we'll see here is that the 2-year, when I took the screenshot yesterday, was trading at around 3 percentage points. And that means that if you expect the yield to go above 3, the 2-year yield to go above 3, you can buy this futures contract and you'll profit dollar for dollar as it goes up. If you expect the 2-year yield to go down, you can sell this futures contract and you will make dollar for dollar as that yield goes down. And you can do the same exact thing on the 10-year as well. You'll notice right now the 10-year yield is actually trading lower than the 2-year yield. This is what is meant by the curve is inverted. An inverted yield curve usually implies that the market expects a recession. Now, how can you trade this? Well, let's say, for example, that you didn't have a view of whether interest rates were going to go up or down, but you did have a view that the curve wasn't going to stay inverted for long, that eventually the 10-year yield was going to be higher than the 2-year yield, and you wanted to just trade that 2's10 spread. Well, very simply, you could buy the 10-year future. You could do the August, for example. You could buy the August 10-year, and you could sell the August 2-year. And you would make dollar for dollar when that narrowed and when the 10-year rised versus the 2-year, and you would lose if it went the other way, if the curve managed to invert more. The advantage of doing it with these micro yield futures is you no longer need to do anything called duration matching. You buy one, you sell one of the other, and you are matched point for point, because what this is it's basically 1,000 US dollars per point of interest rate on these particular futures. Now, just to give you an idea of perspective, you remember that the micro 2-year, the 2-year yield went from 1% to 3% just this year. So in other words, if you bought a micro 2-year at a yield of 1 for when it had a value of $1,000 and it went up, you would have made $2,000 on that trade. If on the other hand you took the other side, if you sold a micro 2-year at 1 and it went up to 3, you would have lost $2,000. Very, 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 very simple contracts, which is why I like them. And if you haven't looked at these before, I encourage you to look in more detail. How do these work on a pure settlement basis? So if any of you are new to futures trading, this is just a very quick crash course on that. For those of you who are more experienced with your futures account, this is just a very quick and colorful review. Let's say, for example, you bought one of these futures contracts. You bought one contract at a price of 3.000, so 3 even, and you had 1,500 US dollars in your margin account to support that. Now then, let's say, for example, that yield, that the price of the contract went from 3 to 3.1. Well, if you bought the contract, that means you made $100, and $100 would be sent by Kenanga into your Kenanga Futures account, and you'd now have $1,600 margin balance in your margin account. And then let's say the next day it went the other way. The price went down not just to 3, but to 2.9. Well, then $200 would be taken out of your account, and your account balance would be $1,400. The exact opposite would happen if you sold futures. So this is my go-to reference for anyone who wants to make sure you really understand how futures settle. And this uses the 2-year yield as an example, just to show you what kind of sizes and directions you're dealing with here. Now, I've talked a little bit about what drives 2-year yields, and I want to also compare that with what drives 10 and 30-year yields. Now, on the very, very short end, if you want to bet on what the Fed is going to do, on what the US Federal Reserve is going to do, you're going to focus on the 2-year. The 2-year yield really is the near-term expectation of what the Federal Reserve is going to do in the next 2 years. If the market expects the Federal Reserve to hike interest rates, you're going to expect the 2-year yield to go up. If the market is expecting the Federal Reserve is going to cut interest rates within the near term, the 2-year yield is going to go down. It's pretty much going to reflect the market expectation of Fed policy over the next 2 years. When does the Fed hike? So if you say you're going to expect what the Fed's going to do, why would the Fed hike interest rates? There are two things that the Fed needs to see in order to hike interest rates. One, they see that inflation is rising and they want to fight inflation, but also they will do it when employment numbers are robust. So in other words, they won't fight inflation if they're worried it's going to cause massive, massive, massive unemployment. That is what you hear is called the dual mandate of the US Federal Reserve: stable prices and full employment. Now, when employment is weak, the Federal Reserve will typically cut interest rates if they think that cutting interest rates will stimulate investment and stimulate employment and ultimately lower the unemployment rate. That's why we paid attention to the economic numbers I mentioned earlier, GDP growth and inflation. That's going to tell you what the Fed is looking at and what the Fed is going to do. Now, another very important thing to say here is who is actually in charge of the Fed. Remember, the Fed is made up of human beings. They are not robots. And so Paul Volcker, when I mentioned earlier, was willing to put the economy in recession to choke off inflation because inflation at that time was very, very high. Jay Powell is not Paul Volcker. And I will let you read into that, interpret that in what you will, but that is what you need to consider when you consider what is the Fed going to do now versus what did it do in the early 1980s. Now, that's the 2-year. What about the 10-year and the 30-year? The Federal Reserve can raise interest rates, and that could have a very different effect on longer-term rates. Why is that? Well, the 10-year is not driven really by the Fed. It's really driven by longer-term expectations of nominal GDP growth. If the market expects inflation is going to remain high for a long period of time, that's going to have a different impact on the 10-year than if they think the Fed is being aggressive and they're going to choke off inflation and things are going to go back to normal. That's what you're going to see reflected in the 10-year and the 30-year. But really the way to read that number is, what does the market expect long-term nominal growth to be? It's also very, very heavily driven by demographics, as I mentioned. The older a population, the lower that country's interest rates. The reason Indonesia can have higher interest rates than the US is because Indonesia has a lot more young people than the US does. Those are the reasons that I mentioned. Balance of pension assets versus demand to borrow, rate of economic growth, and resistance to inflation. Classic example I see here in the developed world is the US versus Japan. So that's interest rates. Now let's move on to commodities. And as I mentioned, I'm going to talk about 3 commodities: oil, gold, and wheat. The first one we're going to talk about with a big black background is crude oil. Now, crude oil, as you might know, is one of the most important and globally traded commodities in the world. And we're talking about it in conjunction with inflation because, not surprisingly, oil prices are very highly correlated with inflation. This is not the best chart, but it's a simple year-on-year rolling chart of oil prices versus the CPI numbers I mentioned earlier. And you can see that while not perfect, the two do tend to go up and down together. Whenever you see a spike in one, you tend to see a spike in the other. Whenever you tend to see a crash in one, you tend to see a crash in the other. And there are several reasons for that. One is that oil has a direct input into many prices that we pay for things, but it also has a great direct indirect impact. If oil prices are higher, the costs of shipping things are going to be higher, and that's going to be reflected in higher costs of things at the store because it costs more money to get there. There are also lots of things which are not energy but are made with crude oil. All sorts of plastics and pharmaceutical products and fertilizer. All of these things are directly or indirectly related to the price of crude oil, and that's why crude oil is still a very, very central commodity to watch for inflation. Now, whenever I talk about oil, somebody's going to say, well, wait a minute, isn't the world phasing away from oil? We're going to renewables, we're going to bioplastics. Yeah, but not so fast. By major projections, and obviously you can get this from different sources, I got this one from McKinsey. The current consensus is that peak demand for oil and gas is only expected to occur around the year 2037. So you've got at least another 15 years of slow growth and then leveling off of growth in oil and gas demand. And only then are you going to start to see oil and gas demand starting to decline. And it's probably still going to be at current levels around the year 2050. So oil and gas is not going anywhere anytime soon. And yes, investing in knowledge of how global oil markets work and how to trade oil futures, I think is something that will benefit you for many, many years to come. Now, in an earlier presentation, I've mentioned that oil was a geopolitical commodity, probably the geopolitical commodity if I asked you about it. And one way of focusing on that is by looking at the list of the world's largest importers and the world's largest exporters. Now, note this is not the same as producers. These are those who sell oil outside their borders and the world's largest exporters who make more than they need and they export to other markets. The US produces a lot more oil than it imports. It's just that it consumes so much that it still needs to import the difference. You'll also notice that I have green stars and blue stars next to some of these countries' names. And the pattern that I want to highlight here is that the countries on the left that tend to import oil are generally members of the OECD. This is the Organization of Economic Cooperation and Development, generally advanced, developed economies, whereas the countries on the right with blue stars there next to their names, with the exception of two, Russia and Canada, are members of OPEC, and only Canada is a member of the OECD, which is a top net oil exporter. So why does this make geopolitical tensions quite important? Well, when a commodity as valuable and important as oil crosses borders, your relationship with the country that's exporting that oil can be quite important for determining oil supply, reliability of that supply, what oil prices are, what OPEC is going to decide to do in terms of production and maintaining prices and so forth. Lots of things to watch out for, and that's why I think oil markets are so fascinating. Now, earlier I mentioned the leveling off of global oil demand by the year 2037. What this chart shows you is where the balance of growth versus decline in oil demand is coming from. Peak oil demand in the OECD, has already peaked. So if you think of the big developed countries like the US, Japan, Western Europe, every year these countries are using less and less oil already. All of the increase in oil demand between now and 2037 is coming from non-OECD countries, and a big chunk of that is just two countries, China and India. China and India are still expected to increase their oil demand all the way out until 2045 and probably beyond. But by 2037, the decline in oil demand from the OECD is expected to be enough to offset the increase in oil demand from non-OECD countries. So that's another important thing to watch, especially in Malaysia, where you see, hey, the economies around me are still using more and more oil. Petronas is doing relatively well. But on the other hand, it's not because of Western Europe and the US, it's because of other growth markets in Asia, which are still increasing their oil demand. Now, in terms of prices, I've given you a bit of the supply side and demand side of the oil picture. What has that meant this year in terms of if you were trading oil futures, would you have made or lost money? It's been a very volatile year for oil futures. If you started the year, with oil prices around $70 a barrel, $75 a barrel, you saw that by March, by the time of Russia's invasion of Ukraine, oil prices went up to $130 a barrel. And then they were quite volatile for the next 2 months. And then by early June, they hit their kind of latest high around $125 a barrel, and then they fell another 25% there. So if you're looking for volatility, if you're looking for a contract where you can make money on something that goes up and down a lot, if you've got a view on which direction it's going to go, oil futures are pretty darn good for that. And they're, very, very liquid market that, is followed by many, many traders around the world. Now, in terms of futures contracts, earlier I was mentioning the interest rate curve, the 2-year, the 10-year interest rate, and so on. Believe it or not, oil futures also have a curve. So those of you who've traded oil futures before already know this. Those of you who are new to oil, when you trade oil futures, what you are trading is the price of a future delivery of oil in some future month. I'm presuming none of you have any interest in taking physical delivery of barrels of oil in a warehouse or in your front yard. Rather, what it is you simply want to buy a contract that if the price of oil goes up, you make money. If the price of oil goes down, you lose money. And you can choose which delivery month that is. Crude oil right now is in something called backwardation. That means that near-term delivery months are trading at higher prices than later-term delivery months. You can look all the way out to December 2023, and you can see that that contract, when I took this screenshot yesterday, is only trading at $80 a barrel, even though the September 2022 contract is trading at $95 a barrel. Does that necessarily mean the price is going to go down in the future? Well, no, but it's the price that you can lock in if you want to trade oil for, say, December delivery or June 2023 delivery. There are several reasons for this. One is future hedging, both by producers and by airlines and by other users. But also it's because you can't just simply buy a barrel of crude oil now and just store it cost effectively to arbitrage that in the future. So when you come up with your oil trading future strategy, you might want to consider which month's contract is actually the one you want to take a view on and which one you want to trade. There are future strategies, just like with the 2s, 10s, that, for example, will be trading the December against the March contract because you expect it to go from backwardation to contango. That's a little bit beyond the scope of what I want to talk about here, but I wanted to point you out to the fact that there are different months of crude oil contracts that you can trade. Now, the last screenshot I showed you was of the big contract, the older, more established one. But I also want to introduce you to the micro one. A big oil futures contract is 1,000 barrels per contract. And just so you know, a barrel is about 42 gallons, or you can figure out how many liters that is. It's a big barrel of oil with a lot of oil. So 1,000 barrels per contract, and they are physically deliverable, meaning that if you held the September contract until September, in theory, the other side could say, hey, we're going to deliver 1,000 barrels of oil, to this point in Cushing, Oklahoma, where you're going to need to take delivery, and you would need to deal with that. But most of you, I'm guessing, don't want to take physical delivery. That's how the prices are kept honest. Now, remember, it's deliverable at any time in the delivery month. So if you're trading the September contract, you're going to want to get out of it by mid-late August. And if you hold a September contract to September, it can go into delivery. So if you don't want to trade the physical contract, remember, you want to get out before the month starts, not during the contract month. So by contrast, the micro crude oil futures is a contract on only 100 barrels of crude. So what does that mean? If oil is $100 a barrel, the big contract is about 100,000 US dollars per contract, whereas the micro is about 10,000 US dollars per contract, really allowing you to fine tune your exposure. The micro crude contracts are financially settled. It actually is a futures contract on the price of the big contract. They look at the big contract and they basically do a calculation to cash settle what it's going to be. And here are the words from the CME website. It's calculated 4 business days prior to the 25th calendar day of the month prior to the contract month. So what does that mean in English? If we're talking about the September contract, it's going to look at the 25th of August, that's the month prior to December, and then go 4 business days before that. That is when the settlement price is going to be calculated for your micro crude futures contract. So very much in a nutshell, if you're trading the September, it's going to be settled by the middle of August. If you're trading the October, it's going to be settled by the middle of September, which you should probably be doing anyway if you trade the big contracts. But if you trade the micros, this is going to be done for you. So that's oil. Let's move on to gold. As I mentioned, whenever I talk about inflation, I always get somebody raising their hand and saying, well, what about gold? Isn't gold, better than the dollar? Isn't gold a safe haven against inflation? In the very, very long term, a little bit, it's okay. In the short term, it's a lousy hedge against inflation. And this is the one go-to chart that I do for this. This basically takes gold prices and a measure of US inflation going back to 1791. So pretty much ever since there was a US dollar, to the extent that you could calculate prices and things in US dollars, you can divide this chart really in 2 eras. So first is the era before 1934. That was an era where really you didn't have a lot of inflation. You more or less had stable prices with some ups and downs. And because of that, the gold price was more or less stable. Obviously, you notice one spike around 1865 when the US was involved in a major war. And then you saw, again, a rise in prices from World War I to the beginning of the Great Depression in the 1930s. That was why FDR confiscated gold from Americans and revalued gold from $20 an ounce to $35 an ounce. So that was that big jump that you saw in 1934. But from 1934 to 1971, the price of gold was fixed again to what was called a gold standard. So gold was $35 an ounce. Other major currencies in the world were pegged to the US dollar in return. And in 1971, President Nixon took US off the gold standard, not because he was necessarily trying to do anything evil, but because you can see by the inflation number here, the dollar really wasn't worth $35 an ounce anymore. It really needed to be adjusted. Now, what happened when the dollar was taken off the gold standard? The price of gold shot up, but according to this, it overshot. It not only went up to what the price of gold should have been, but it went to about twice that much, which is why for the next 20 years, from 1980 to 1999, 2000, the price of gold went in one direction, and that was down. It went from $800 an ounce to about $200 an ounce, even as inflation continued to tick upwards. Now, in the 2000s, when you saw a commodities boom, you saw gold going from $200 an ounce to $1,800 an ounce. It's been roughly flat for the past decade. That's because, once again, it's overshot the actual rise in inflation. The lesson from this chart is that over really, really long periods of time, yes, gold needs to snap back to what its inflation-adjusted price should be. But in the short term, it does a very, very lousy job of doing that. And we've especially seen that this year as well. As I just showed you, year on year, from 1 year ago, consumer prices are up 9%. And over that time, the price of gold is down 5%. If you bought gold a year ago because you expected inflation, it really did a terrible job, for you in that. Now, that said, part of the reason for that is not just because of the price of goods in dollars, it's the price of dollars relative to other currencies. Really, what is gold in the short term? Really, gold is a bet against the US dollar. So in other words, why has the price of gold gone down? It's because the value of the dollar has gone up. It's because in terms of everything else, when you've seen kind of an unwind in equity prices, asset prices, and so on like that, you've seen debts by foreign issuers getting paid off, there's been a rush to buy dollars, which is a flight to quality asset. So if you were to look at the price of gold in euros or pounds or yen, or ringgit, it might not look so bad versus when you look at it in dollars. But if you're going to be trading gold futures, like the ones we're going to be talking about now, it is a futures contract on the price of gold in dollars. Very, very important to remember that, because really what you're trading is you're trading the dollar. What are these futures contracts? So as I mentioned, like with oil, you've got micro oil and you've got micro gold. Micro gold futures contracts are on 10 ounces of gold, unlike the old gold futures contract, which are on 100 ounces of gold. So what does that mean? Let's say, for example, if you wanted to trade the October 2022 futures contract, which here was quoted at $1,739 an ounce, that'd have around $17,390 notional value, 10 ounces of gold. You could buy that or sell that to get exposure to rising or falling gold prices. It really is probably one of the easiest and most flexible ways to gain exposure to gold, if that is still something you want to do after what I've said about it. Now, the main competition or the main choice you often have, obviously with gold, you can buy physical gold if you want to own bars and put them in your safe. You could trade futures like the one I just mentioned, or you can trade it as an ETF. What's the plus and minus of futures versus an ETF? Well, with futures, you don't need, if you want to trade $17,000 worth of gold, you only need to put up the margin requirement for those futures. You don't need to put up all $17,000. You don't need to lock all $17,000 into gold. You can also get long leveraging financing on the long side, because let's say you put down $5,000 and you get $17,000 worth of gold. The financing rate is already built in. You don't need to pay margin rates or anything. If on the short side, let's say if you want to get exposure to the price of gold going down, you can sell a gold futures just as easily as you can buy one. You don't need to borrow anything. You don't need to pay margin rates on short positions or anything like that. You just click short, you've got a short position, and your margin is going to be managed like any other futures position. What you see is what you pay. It's all in there. It's all wrapped up. I think basically if you're taking a short-term trading view, futures are a simpler and easier way of doing it. Now, one thing is, though, if you're looking to have a permanent allocation to gold, if you're looking to stash gold away for 100 years, futures are not right for you, because you need to roll them every time your contract expires, usually every 3 months or so. So really not good if you're looking to have like a 10-year allocation to gold. In that case, you want to have an ETF or maybe even just physical bars that you put in a vault. So when you buy an ETF, you need to fund it in full. If you're going to buy $17,000 of gold ETFs, you need to buy $17,000. If not, if you want to leverage it up, you need a margin loan and you need to pay margin interest rates on it. If you want to short an ETF, you need to borrow the shares and pay margin interest on your short. Your expense ratio means that even though you buy your gold ETF, over time, that share of the ETF is going to hold less and less gold over time, because the ETF sponsor needs to get paid and they sell off some of the gold, which is why a share of GLD now no longer represents 1/10 of an ounce. It used to, but it represents less and less gold every month as if they sell gold to cover their expenses. But the big advantage is you can buy and hold it, quote, forever. You don't need to worry about rolling. Last but not least, let's talk about wheat. Wheat is just one of many agricultural commodities you can trade, but it's one I wanted to focus on because, well, first of all, it's very, very topical to Ukraine. And it's one that you can trade in America, you can trade in Europe, and I think it's even relevant in Malaysia because you need wheat to make a good roti canai. And I hope to have one next time I'm back in Malaysia. It's been a while. So what's the deal with wheat? Wheat is one of the world's major food grains. It's used globally to make bread, pasta, cakes, obviously you kind of know. Now, the main contract we're going to be looking at, and this is very important, is the Chicago wheat contract. That is different from another type of wheat called the Kansas wheat contract. And of course, that also is not going to be the same kind of wheat that's traded in Europe. So the type of wheat and where that wheat is traded is important whenever you're talking about wheat markets, because chances are the roti canai that you're having in Malaysia is not made with Chicago wheat. It's not made with the same type of wheat that we're dealing with here. So pay attention to the dynamics if you're going to be trading these contracts. If you want to get deeper into the weeds on wheat, you're going to want to look at both the Chicago and the Kansas contracts and probably trade them. Now, if you want to look at ags more broadly, there's also corn and soy. Those are two other major, I would say staple food futures contracts you might look at. Now, that's kind of the big picture. Now let's focus on Chicago wheat specifically. It is priced in cents per bushel. What's a bushel? A bushel is 8 US gallons. That's about 35.2 liters. So imagine a really big barrel that you're going to fill up with wheat, and then you're going to send it off to the miller to turn into flour and turn into bread. That's what it is. The big wheat contract is 5,000 bushels, and there is a mini wheat contract, which is 1,000 bushels. And remember, the prices of wheat contracts are quoted in cents per bushel. That'll give you an idea of what the sizes are going to be. Now, earlier I was mentioning some of the different ones you could trade. Here is a market share chart. Why am I talking about Chicago? Well, it's just by far the most heavily traded and the most liquid one. About 60% of the global wheat futures volume is the Chicago contract, and that's followed by the Kansas contract. So Chicago and Kansas together are about 90% of global wheat futures volume. If you're specifically interested in trading Ukraine, you'd want to trade what's called Black Sea wheat. But you can see the volume on that contract is much, much smaller. You can go try and get some quotes on that, follow that to at least see, what the steps of it. The next closest thing you might want to look at for European wheat is the Euronext contract, which as you can see is more like 7% of global volume. But why am I talking about American wheat, even though Ukraine is what got into the news? That's where the liquidity is. That's where you can see the impact. Now, just like any other commodity, there is a curve. In other words, when you're trading wheat, you're not trading physical wheat, you're trading the price of a delivery of 1,000 bushels of wheat in December. And if I look at the December 2022 contract, what do we see there? We see 777 and 4/8 cents. Now, why is it quoted in eighths of a cent? That's just convention. But $7.77 and a half cents per bushel. And if you trade the mini contracts, that's going to be times 1,000 bushels, so roughly $7,700 worth of wheat. You buy the contract if you think the price of wheat is going to go up. You sell the contract if you think the price is going to go down. You can see by looking at the different months what the seasonality is, say around harvest time versus what the cost must be to store it in a grain elevator between harvest and say December or March delivery. If grain elevator storage becomes really, really tight, you can probably capture that by trading the December contract. We go in that in a lot more detail, but here is your crash course on what wheat futures look like and how you can trade them. What have wheat futures done so far this year? Well, kind of like oil, they've had a wild year, a wilder year than gold. Basically, when the Russian invasion happened, we saw a spike in prices. Basically went up from about 750 cents a bushel to around 1,250 cents a bushel. And it's basically remained over $10 a bushel for most of the spring until the end of June. And then wheat prices have recently crashed back down to around 750, 800 cents a bushel. So yes, just like oil, you're going to get some volatility in it. But unlike oil, the dynamics of wheat prices are very, very different than the dynamics of oil prices. I hope for any of you who have never traded wheat futures before, this is interesting to you to learn a lot more about the price of food commodities, because I personally think it's quite fascinating. And here is how you trade them. Now, big picture. I've talked about a lot here. I've talked about interest rates, oil, gold, wheat. How do you use all these? How do you put them together to build your strategy on these economic futures? First and foremost, all of you, any of you attending this, I recommend start with the interest rates. Start with those micro yield futures, because those are numbers that everyone has to watch. Whether the short-term interest rate is 1% or 3%, it's going to affect listed companies in the S&P 500. It's going to affect farmers. It's going to affect oil producers. Those are the numbers to start with first, because that's really driven by those economic variables I mentioned. Now, if you want to trade oil, as I mentioned, has a cycle that feeds inflation and is driven by inflation and back and forth. but also is driven by geopolitics, is also driven by the energy transition, is also driven by how much did ExxonMobil invest in drilling capacity 5 years ago. Those are things that are going to affect oil prices that may not affect interest rates in the same way. Gold, as I mentioned, is a lousy hedge against inflation in the short term. It's really a trade on the US dollar. And agricultural commodities like wheat really are to capture not the energy portion, but the food portion of inflation. They can be driven by event-driven spikes, like an invasion of a major wheat-producing country, but each market is very, very different. So Chicago wheat is going to be different than Black Sea wheat, and those are things you need to keep in mind if you want to trade one as a proxy over the other. So that was a lot of information, I know. Here is my contact information in case you'd like to go to my website, send me an email, follow me on Twitter, follow me on Seeking Alpha, I think that was probably even a little bit more time than I was allocated, but Shane, I think we've got some time for a few questions now.
Yes, thank you so much, Mr. Tariq Dennison, for sharing with us a very insightful session on the market outlook for 2022, as well as sharing with us the strategies that we can use with futures contract to hedge against the inflation. All right, so if you have any questions for our speaker today, you may write them in the Q&A box or the chat box. We'll attempt to address them within the next 5 to 10 minutes. We have another speaker coming up, so do stay on this session as we have some prizes for you to win as we are going to conduct a game shortly after this session. All right, so if you have any questions as our speaker, please write them in the Q&A box or the chat box. All right, you may write them on Facebook if you're tuning in from Facebook, or YouTube chat if you're tuning in from YouTube. Any questions?
I actually have to admit I have one question. I haven't been back to Malaysia since 2019. Can anyone tell me if the price of a roti canai has gone up by much?
Well, it should be around 2 ringgit.
So, yeah.
What was the last price that you had it?
Well, probably around then. I mean, it was always kind of a staple, but I always kind of feel like on the very, the real staple, the basic items, always kind of worry there if, if you saw it go from 2 to 3 and you can't find a 2 ringgit one anymore, that would be, something, but.
All right. Okay, we do have one question from Bob.
Yeah.
Yes, yeah. Hi, Tariq. What do you see in oil outlook in the next 12 months with rising interest rate? Is it a good strategy to sell further months?
Okay. Well, so that was a good one there. Now, you did one thing I did was very careful to highlight. I thought it was very important to highlight is what the oil curve looks like. Because remember, the front month is around 90. When I took the screenshot, front month was around 95. Later months are around 80. Now, that can mean a few different things. It can basically mean that oil producers that want to lock in that further production are happy to do that. It's going to take a while for that oil to come on supply. Those that can sell their future production at $80 a barrel are very, very happy to do that. After Cathay Pacific, not a lot of airlines want to buy their oil out that far. So really what I have to say is you have to, if you are selling future contracts that say around 80, you're really in a way betting on something like a 2014 scenario repeating. It's not just a matter of rising rates, which would affect obviously the demand side, but you also have to consider the supply side. Because one reason that oil went up this year is the one major supplier, Russia, basically was sanctioned. A lot of countries said they weren't going to buy oil, and when you have fewer places to buy it from, that's going to push the price of oil up. Now, OPEC could respond by, pumping more oil, or they could keep the supply constrained because they really like selling oil at $80 to $90 a barrel. You really have to have a view on what all of those are going to be. Now, what caused the oil price crash in 2014? That had to do with a real glut of supply that came from North America. There was a lot of investment in the late 2000s, early 2010s in shale oil and tight oil drilling and so on like that. And that meant the US was producing lots and lots of oil that basically flooded the world supply from non-OPEC sources. That's why oil went from $100 a barrel to like $30 a barrel very, very quickly. So that's on the supply side, something that has to happen for you to really profit from oil futures plummeting. I didn't get to talk about oil options here, but if I were to take an oil futures position, just given which direction it's, how volatile it could be in either direction, going to 140 or 60, I'd probably prefer a very specific option position than just taking it outright, in my view. But that's my opinion, John. Always keen to hear what you think of oil.
Thank you so much, Tariq. Okay, I think there are people who are asking, is there any playback after this? Yes, you may catch the playback either on the GoToWebinar where we'll send you the link, or you can catch it on our YouTube channel. All right. Okay, looks like there are no more questions for you, Tariq. So thank you so much for sharing with us the market outlook for the second half of 2022, as well as the impact on the rising inflation and also interest rate. Thank you so much, Tariq.
My pleasure. Thank you for having me.
All right, so before we transition to the next speaker to conduct an interactive game, so let me just do a quick shout out, which is, Kenanga Futures is going to launch a campaign for you to trade the CME futures contract that Mr. Tariq Dennison has just mentioned just now. So if you trade any of the futures contract listed on CME, you're going to earn up to 28% cash back. All right, so stay tuned for more of the campaign information, which will be released to you on the 8th of August. All right, so next up, we are going to introduce and call upon Nicholas Tan from Kenanga Futures to conduct a mini game where we'll give away prizes in GrabFood vouchers to all the participants who win in this contest. All right, without further ado, shall we have Nicholas here on the line with us?
Hi Shane, can you hear me clearly?
Yes, I can hear you, but you can't see your webcam yet.
All right, let me share. Can you see my screen?
Yes,
see my screen?
We can see your screen.
Okay, good. All right, thanks for the introduction. And it's a game session now. Oops. All right. Okay. There's a wonderful sharing from Mr. Tariq, and also thanks Shane for hosting it. And it's our game session for tonight. So before I start, let me introduce about this. I think Shane just have mentioned Kenanga Futures is gonna launch a campaign up in 8 August next month. The campaign will last for 3 months, from August, September, and October. When you trade CME group products, you can earn up to 28% cashback. So do stay tuned and check out on Kenanga Futures website for more info, right? Okay. Next thing, so it's going to play a game session. So for those that have account before or play this game before, you may proceed to log in. For those that have there's not, you can scan this QR code, or you can key in the web address at the below. All right. So let me show you some of the screen. All right. Let me see. Okay. So if you have scanned the QR code or key in the web address, it should lead you to this page over here. So this is the game that we're going to play tonight. It's called Virtual Trading by Kenanga Futures. So what this game is all about is actually a simulated trading environment that provides you a hands-on trading experience on how listed derivative works. So before you committed your real capital in this market. So some of the objectives, we try to bring it to you. And what you can learn from this game, you can read more later on this website. So how do we proceed? You can just scroll up to the top and click Start Game. Click the Start Game button. Once you click the Start Game button, it will lead you to this page over here. For those that have an account, you may proceed to log in. And for those that is new to this game, you may scroll down to the bottom and click this Sign Up button here. Click Sign Up. All right. You may upload your profile pictures, and then set your display name. Display name is gonna be shown to everyone in the game, right? And key in your name as per your NIC, not your IC number. Yeah, your name as per your IC or passport or any other ID, right? Your full name, and then key in your mobile number and your email. Make sure these two is accurate, right? Select your gender. If you have a referral code from your friend, you may put in your referral code. If you do not, you can just leave it blank. Select your nationality and state, and set your password and confirm password. Before check, remember to check these two boxes, and also check that you are not a robot. You are not a robot here. And then proceed to click sign up. Once you click this sign up button, you should be expecting to receive an email from kfvirtualtrading.com asking you for verification. So you need to go to your email that you have registered here and click the red button to verify your email address. Once you click the red button in your email address, it will lead you back to this page, and you may proceed to log in with the email and password you have set just now. Do remember to check this box over here before click sign in. Okay. Once you have clicked sign in, it will bring you to this game dashboard here. All right. Okay, so let me go through with you what is this game is all about. So this is a virtual trading game. So all cash or capital committed in this game is virtual. All right. Okay, on your left, you can see there is a game dashboard over here. There is a public game. There is also private game. Public game, you can play as many times as you want. Private game is specialized for some special occasion or special session only. I will go through with you each of these later. So on the left, you can see there is leaderboard. So leaderboard will record all the game that play in your public game. So you may invite your friends or family and play this game together and challenge each other in this leaderboard. If you would like to know more about the products that you are playing, you can always go to click contract specs. Let's say, for example, you can go to NYMEX. Let's say select E-mini Crude. So you can see E-mini Crude is listed on the NYMEX exchange, the product name, the product symbol, the contract unit, and things like that. So the margin, maintenance margin, and is cash settled. And if you want to know more about the contract specs or the full contract specs, you can always click to CME Group website here. And on your left, next one is invite friends. You may go to invite friends and invite, send email invitation to up to 10 emails at once to your friend to join you in this virtual trading game. And this is your referral code. You may also share it via WhatsApp, Facebook, and LinkedIn. And then game walkthrough is gonna introduce you how this game is gonna be run and how you can play this game. So I'll walk through with you. This is for your own info later. So all games will come with rules. So this is the rules of game is a bit wordy. I will go through with you as when we play the game later. And if you want us to contact you, please let us know. Would you want us to contact you via email or by phone number, or you can call us directly. This is our direct line and also email address. Later, before you sign up, do remember to rate us how many stars, and also put down your reviews and before you click sign up, so we can know how we can improve further. And on the left, there are some buttons over here. If you can see, there's open account button. So opening an account with Kenanga Futures is totally free. So you do not have to pay anything, and the account opening process is 100% online. There is no signature or printing out of documents required. Everything is online, and it can be done within minutes, right? So if you want to know more, read more about some education materials, you can always click this button. And you want to check out all our events calendar for our futures event, you can always check out in our event calendar here. Right, let's go back to the game dashboard. Okay, so you can see there is a public game and also private game here. So for example, for public game, there's a lot of games here listed now. You can pick and choose any of the games that you want to play. For example, today, let's say we talk about energy or some commodities. Let's say E-mini Crude Oil Futures. You can move your cursor to this eye, and you can see that the product information. And let's say I click join. So the game has started. If you notice, the product that you are trading is called E-mini Crude Oil Futures. The exchange is on NYMEX. It's listed on NYMEX, the product. And initial cash balance is 30,000 US dollar, meaning I'm giving you 30,000 US dollar to trade this product. The initial margin and maintenance margin is at 4,730. So initial and maintenance margin. In this game environment, we try to make it simplified, so the initial and maintenance margin we maintain at the same level, right? Game duration is 60 days, and the trading day is 10 seconds. What it means here is every trading day is going to be 10 seconds. For our real life day, one day we have 24 hours. In this game environment, one day is equivalent to 10 seconds only. So every 10 seconds, if you notice, every 10 seconds counting down from the timer, if you move to the next day, right? So if you notice over here, you can see there is a candlestick chart with open, high, low, close, and volume figure for each bar chart. And there are simple indicator like RSI and MACD. Right over here, you can zoom in, you can adjust the parameters right from here. And this countdown timer will count down from 10 to 0. Every time is count down to 0, you move to the next day. And every day there's only one price shown. This game will try to make it very simplified to let you understand how futures trading really works. We understand that there's a lot of people they do not know how to really trade futures, and they're not short the market if the market is going down. They always know how to buy low and sell high, and they didn't know that they can actually sell high and buy low later, right? So in this game, I hope that you can learn that and also explore some of the futures mechanics on how it works here. So there is a quantity that you can key in. How many contracts do you like to enter? There is a buy and sell button, and there is an account info here. So on every day, what you need to do is you need to decide you would like to buy, sell, or to do nothing. So if you think the market is going up, let's say I buy 3, or let's say 2. I buy 2. So on order journal here, you can see on day 16, I bought 2 contracts at this current price. And if this following day, the price has went up from 31 to 31.52, I make a profit over here. So I'm given 30,000 US dollars to start with. I make a profit of 210 over 2 days with 2 contracts. And now it's 180 on the third day. For example, if I would like to take profit and close my position now, I can hit sell, and that's it. This is the profit that I made over 2 days. 3 days. So on day 16, I bought 2 contracts at this price. On day 19, I sell 2 contracts and close up my initial position. So if I think the market is going down, you can always sell the market, all right, when the market really go down, or you like to add on position. Let's say I can add 1 more into 3 contracts. You can always do that, as long as you have enough margin or enough net capital for you to enter another contract. You can always do so, right? So all this will be automatically calculated for you, right? So let's say I close up my position. Okay, so this is the game that we're gonna play tonight. So I have run through a few things like that. Your objective for tonight for playing this game is first, of course, I want you to enjoy the game, and second, apply the things that you have learned throughout the session just now, and also try out how futures really works and start trying with some virtual capital that are given, right? And at the same time, I wish that all of you good luck, and will make good progress and also win some prizes tonight. So please move to private game, right? Scroll to the private game, scroll to the bottom. You will find this game called webinar on 26 July, QM. You click join. You will require you to enter the password. The password for tonight's game is Crude, CRUDE 2022. Let me show you. Okay, so the password is called Crude 2022. You may key in. Okay, and you're in. Is everyone in? Right, the password is called Crude 2022. Let me show you again. Password is called Crude 2022. Okay, I see people is joining in. Oh, okay, if you notice, the timer is not moving, right? The day is also fixed over here because I have not started the game yet. So I'll wait for everyone to join the game. Then I will start the game all at once, yeah? I show you again. The password is called Crude 2022. Right, I still see people joining in. All right, I still see people joining in. Okay. All right, let me go through with you again what we're gonna do for tonight. So tonight, same thing. We are trading E-mini crude oil futures. Initial cash balance, I'm giving you 30,000 US dollar to start with. My initial margin is 4,730. Game duration is going to be 60 days, and trading day is going to be 10 seconds. So over here, let me repeat. Every day, it will last you 10 seconds. Every 10 seconds, you move to the next day. So every day, you need to decide what you need to do, to buy, to sell, or to do nothing. If you would like to buy or sell, please set up your quantity of contracts. Okay, so let me see. All right, we will be starting the game soon. All right, I will start the game now in 3, 2, and 1. The game now has started. If you notice, the timer has started to count down from 10 to 0. So let's say, for example, this day, I would like to short one contract as I sell. On day 2, I sold one at this price. On day 3, I make a profit of 5. Or let's say I would like to decide to close my position, I just hit buy. And that's it. You can do as many times as you want to buy or to sell every day. Right? And we'll be giving out GrabFood vouchers to the top winners for this session tonight. So to the top winners, we mean those whoever that generate the highest profit or the highest ROI during these 60 trading days. Right? Now it's day 6. I will be coming back on day 60, and I hope you enjoy the game. All right, welcome back, and I hope you enjoyed the game. So it has ended at day 60 now, and actually you have experienced a 3 months of trading period. So I hope that you enjoy the game and also survive in trading futures, especially for if you are new in this futures trading. Because first thing is in futures trading, everything is about survival first. If you are on trading, so if you can last for like 3 months, basically 60 trading days. So every month like 20 tradings, 20 trading days, and 3 months can be 60 trading days, and you should be doing good in the real market. So let me show you on the ranking and the winners for tonight. All right, so here we have the leaderboard is up on everyone's screen. So congrats to the top 3 winners for CM. Very good in making 390% in ROI, and follow up with Chiho 18, 35%. RCT Chan, I suppose, is 29%. Congrats to the top 3 winners, and we'll be giving out 20 ringgit of GrabFood vouchers to you. And to redeem your GrabFood vouchers, kindly ensure that your contact details in the profile are accurate, and to expect a verification call from Kenanga Futures within this week as part of our verification process. So to confirm your details is accurate, you may click your profile picture over here and ensure your mobile number and your email address is accurate. Right? So to expect a call from us, and failure to do so will result in prizes being forfeited and hand over to the next qualified winner. However, please take note that we will not ask for any private information such as your IC or banking details. So there's a lot of scams called recently. So what we need to do, what we will be doing is only we'll be calling the winners and check that you are playing the game for the tonight, and we'll just congrats you, and we'll be sending you the prizes. Right? So and you can always come back to this game and explore some other products, right? And you can try as many times as you want and practice your futures trading skill over here, or familiarize some of the products, how it being traded, right? So I think I'll pass the session back to Shane. Shane, over to you.
All right, thank you so much, Nicholas, for conducting this very interactive game for the participants and us to experience how does this feel to do live trading on the futures market. So thank you so much, Nicholas. All right, so ladies and gentlemen, you just heard from Mr. Tariq Dennison about the market outlook for the second half of 2022, and he also played the game conducted by Mr. Nicholas Tan. So I hope that you all have gained enormous value learning about the different futures contract, inflation, and also the impact of rising interest rate, and how do you use a different futures contract and meet your financial objective. All right, so may I just share my screen for a bit, if I may? Okay. Okay. All right. For the last shout out is that if you have just learned about the different futures contract in wheat, in a micro yield, in gold, and in crude oil, you may trade all of them via Kenanga Futures. Kenanga Futures offer all these CME group products. So if they are also launching a campaign on the 8th of August, 8.8. So waiting for this campaign information where you can earn up to 28% cash back. So if you haven't had any Kenanga Futures trading account yet, you may sign up one now at the link that I just given you at the chat group. So if you already have a futures trading account and you want to try out Kenanga Futures, you may also sign up the form at the form that I've given you. So Kenanga Futures will arrange a friendly futures broker representative to cater to your needs to open a trading account with them. All right. So with that, I want to thank all of you for tuning in to this session brought to you by Kenanga Futures and managed by Wealthford. So thank you for spending your precious time with us. We hope that you'll gain enormous value in this session. With that, wish you the great rest of the day. So see you in our next webinar. Bye-bye. Thanks, Nicholas. Thanks, Tariq.